Welcome to today's Corporate Venturing Insider Series. Today, I am so happy to have Rohini, who has an amazing journey of VC and CVC and VC. So I know we will have a lot of golden nuggets. Rohini, welcome.
Thank you, Nicolas. Morning.
So let's start with your journey into corporate venturing. Can you share how you got into it? What was your journey?
Absolutely. Yeah. Thank you for having me. It's really wonderful to spend an hour here with you. So my journey into corporate venture, so maybe I'll just go back a little bit further before I got into venture. I am an engineer by training, came to the US as a grad student, and I came to the Bay Area to work in networking. I joke that it was the AI of the 90s. So I worked as a network engineer, hardware design, chip design, board design at a company called Bay Networks. And then I went to business school at MIT Sloan. So I went to Sloan to get my MBA, and which is where I was exposed to a lot of entrepreneurship. I was part of the MIT 50K, and I was part of the first MIT VC conference. So really got to know about venture and startups while I was at Sloan. And I actually got into to venture sort of through an introduction from a classmate of mine. So one of my classmates had worked at Intel before she came to Sloan, and as we were talking about all the things I was interested in and so on, and she's like, you should think about Intel Capital. So she made that introduction, and I was fortunate enough to join as an associate. I was called an investments manager. I started in '99, and so this was, it was still in the middle of the boom, and so I joke that I saw the boom and the bust within a year and a half of joining venture. So a lot of what I learned was at Intel Capital. So I was at Intel Capital for 7 years, so '99 through '06, and really invested through a cycle and got to see a lot of innovation that happened in that first cycle. So post the dot-com bust and pre-cloud. So as mobile was happening, wireless was happening, I was in the middle of a lot of those things. Um, and then I had a second stint in corporate venture as part of NGP Capital, which is Nokia's venture arm later. But in between, I was at NEA for almost 9 years, investing as an institutional venture investor in enterprise investing. And now I'm managing partner of a venture firm called NewBuild Venture Capital, which also has some elements of corporate investing in it. So happy to kind of dig into any of those things. And maybe just a minute on the new build idea is that we do want to work with corporate LPs, and we have this view that there is a model that you can build with multi-corporates investing in innovation that is further out. So when you're thinking about eyes and ears innovation, finding these ideas that you can actually discover more if you have other corporate LPs around the table who are also searching for similar ideas, and you have an experienced set of investors leading the charge on making those investments. So we'll come back and talk about that. But I have been fortunate enough to see corporate venturing over 20 plus years, and I really think it's an interesting and very differentiated part of venture, and it is a growing part of venture. So I'm really excited to have this conversation.
Thank you. I think one thread that's obvious is technology. From engineering background, even the business school in MIT is kind of
Yes.
technology. And then Intel Capital, NEA, NGP, and even today what you do, there's this one thread. So maybe you could talk about the value of your engineering background
Yeah.
combined with the business school. How does that make you a better investor?
Yeah, no, absolutely. I still think of myself very much as a fairly technical product market investor. I really enjoy sort of the business of technology, and that's where I've been in my entire career. I've spent my entire career trying to understand what technology innovation means, what economic cost points does it enable, but also there's a big element of communities in technology. So, the adoption of technology is not dependent just on the invention, it's also dependent on the demand side, where, who is receiving it and who is enabling it. So, for example, during our careers, we've seen the growth of open source. Like, there was nothing that was written beforehand that this would be the industry structure, that there would be a lot of people who would write code and share it transparently without knowing exactly what the monetization model was. But it has happened, and it's been there is a gravity to open source adoption. So things that get adopted matter more. And similarly, understanding what is the cost curves of various types of technology and what drives them has also been one of the threads I've been very curious about. And part of the MIT background is relevant to that as well, because we really do study technologies that will get cheaper over time, or we are dealing with things where marginal cost is zero in software. Like, you can make more units without having additional costs and so on. So that intersection of new technology, new economic cost points, and new usage or new communities, that has been the area where I have been most interested in over my career, and continue to do so.
So I will double click later on open source, because I think there are a lot of non-obvious insights for investors to understand, and community as well.
Yeah.
But I think you were very lucky indeed with Intel Capital, one of the top CVCs even today. So it's like
Yes.
decades later and still doing so well and so impactful. And you did a boom and bust, which I think many investors who are recent in VC or CVC haven't had an experience of busts. You had it very quickly in your career. Can you share a bit about what it was the first 2-3 years at Intel Capital and your early learnings?
Yeah. Absolutely. Yeah. So I think when I first joined Intel Capital, this was 99. There were probably almost 100 investors, and Intel Capital over time has gotten to that size and shrunk over time. I don't know exactly how many there are now. They're probably less than that, but it was quite big. And sort of, to be very candid, that was really the starting point. I joined straight out of business school, and I was trying to figure out like how this whole system works and what investing is all about. And it turned out to be a very good training ground, right? So at that time, the leader of Intel Capital was Les Vadez, who was he was, I think, employee number 4 at Intel. He had a lot of gravitas within Intel, and essentially had created Intel Capital a few years before that. So I think around 94 or 95, with this idea that there was an ecosystem around Intel. So Intel is a component company, and yes, there's a software ecosystem, but I think there was also this idea that as a manufacturing company, you needed to have a supply chain that you were actually investing in. So a lot of the early Intel Capital investments had been in semiconductor manufacturing, smaller suppliers, trying to capitalize them and so on. By the time I got there, there was a lot more of this ecosystem thinking idea, which is, if we bring out these new platforms, especially if you bring out servers, let's say Itanium was, there was an Itanium line that was coming out at that time with HP and so on. And there was this move towards servers, which was new. And Intel was starting to think about what is the software ecosystem that needs to go around that. And a lot of investments were around that. So when I first joined Intel, what we were tasked with was to start exploring the space and what is the landscape around Intel, and how could we use investment as a way for us to be much more tightly integrated, or maybe incentivize people to actually include Intel as part of their product lines and so on. It turned out that I had a background in networking, so I pretty quickly got pulled into a lot of the networking deals. So some of the ones that I worked on a chip company called Sandburst, which eventually got acquired by Broadcom. I invested in a company called Netscaler, which was in load balancer. Eventually got acquired by Citrix, became Citrix's big load balancing platform. So these were even in the early days. I was doing things. I was doing investments that were in the networking space, and my first couple of years, as we went through the bust, Intel Capital actually shrank. So there were many people who left. There were probably a couple of rounds of layoffs even at that point. This is in the 2000 area, and I inherited a number of investments as well from people who had made those investments prior to leaving Intel Capital. So companies like Teja, which was a network processor OS, and several chip companies that, at that point we had invested in and we had to triage. So a lot of that learning came from, when you have this hypothesis about what that landscape is when you make an investment, and then you have to look at the particulars of what is that business separate from Intel's interest or Intel's business. And would you make this investment now? Would you continue the investment you're making? That triage actually taught me a lot about investing. The other piece of it was it eventually led to my joining the Wi-Fi group. So around 2003, most of the activity migrated to Wi-Fi, networking activity migrated to Wi-Fi. And Intel, if you remember at that time, came out with this platform called Centrino, which was a way to actually start including the Wi-Fi capability on the client side. So, networking has a classic chicken and egg problem, right? Somebody has to either build the network and then you bring, build the cellular network and then you bring in the phones, or in that case, Intel actually reversed the strategy, which was to say, let's forward price and make sure there are clients available. In this case, there were laptops with Wi-Fi, and that enabled the creation of the network side of the so the network access points and so on. We made a number of investments on the network side in order to actually make sure that this industry got up and running. And eventually, Wi-Fi has now subsumed Ethernet, right, in the enterprise, and really successful kind of product introduction, if you will, or market building. And then that also eventually I kind of migrated to thinking more about the WAN. At that point, there was a technology attempt called WiMAX, and many people might remember that. And it was really informed by the success of Wi-Fi. So Wi-Fi introduced a number of interesting technology innovations. So, for example, the physical layer, for the first time, there was OFDM that became part of wireless networks. So at that time, cellular networks were still in the GSM and CDMA world. And WiMAX was this thought process that said, maybe at this OFDM physical layer change, maybe you could also migrate to an IEEE standards type change rather than kind of the GSM world at that point. So we were very active. I call it the anthropology of standards committees. How do you standardize a technology? How do you work with other counterparties from with very different contexts and maybe geographical interests and so on. And then also, how do you enable an ecosystem around that? So I invested in a company called Beseem, which was which eventually became part of Broadcom and became the 4G LTE standard. So the technology stayed on and did other things. Invested in a company called Navini Networks. Invested in the first spectrum investment called Unwired Australia, which was the big holder of 2.5 gigahertz spectrum, which at that time was unused spectrum. Cellular technologies didn't work in that spectrum, and we said, oh, maybe we can use WiMAX to actually make new spectrum band more interesting and economically viable. So I led that investment. So really, Intel Capital allowed me to kind of learn, first of all, the investing skill set. So investing alongside some fantastic investors, co-investing, being a steward for Intel's interests. So I was in that time frame. I was mostly a board observer, learning about what was happening in these companies, but trying to figure out how these companies mattered to Intel, how to be a champion for these companies within Intel, as well as the other way around. And then most importantly, these technology innovation cycles, sort of what does it take to actually introduce new technologies, and sometimes also like where does value migrate to, like the person who does all the hard work may not be the person who actually reaps all the rewards.
Yeah, the value creation and the value capture
value
are not
value
always.
capture are not always synchronous. And so I learned a lot about that at Intel, and really was very fortunate to participate in some of these. And because I was always kind of working on these cutting edge programs, I also got to be part of, Intel had these things called slurps, the strategic long range planning cycles, and I got to participate in a couple of those, interacting with various people from other parts of Intel. And that sort of goes back to your point about how do you bring some of this learning back into the mothership.
Yeah.
So I was exposed to a lot of that and really enjoyed my time at Intel.
So I think you're the first one in over 80 podcasts to actually talk about the mothership, the corporate VC, and the standards activity. So I don't know if you know, but my very first job was in standards.
Okay.
And so I'm really curious about some of the best practice or insights you got from, because we are not talking about enabling an ecosystem here. We're talking about unlocking an ecosystem. Like Wi-Fi did not exist. You have the chicken and egg situation. How do you unlock it in a way that it's not just you create the technology on both device and network, but you also start the work of standardization early enough that it actually can have impact. Can you talk about these coordinations between corporate venturing and standardization?
Yeah. No, I think, there is a lot of discovery that happens. There are patterns, of course, that you can recognize in these things. But one of the things that in being part of the standards, and for a brief period, I was a voting member of 802.16. So you actually become a voting member by attending. You attend a certain number of meetings, and then you get a vote, right? It's so it's not based on your company. Like you have to be there personally to do that. So I think the standards process, a couple of things that I learned along the way, where it is all about these people who have their own, it's really a very democratic process in some way. Everybody's kind of doing their own thing. They have an interest in creating a larger ecosystem, let's say. And it was not just Wi-Fi. Peripherally, I was exposed to USB, for example, like the creation of the interconnect standard, or WiMAX. And I had worked as an Ethernet engineer, so I knew sort of the transition from 10 megabit to 100 to a gigabit and so on. So I was very aware of how important these standards were. And what the standards really do are, they are effectively defining interfaces. So you can innovate within a box, but then the interfaces between those boxes are defined. And going back to networking, there was the OSI stack, if you remember, right, which was all about that. You essentially take layers and you essentially say these are the interfaces between layers, and therefore you can have various actors, whether they're large companies or small companies, IP block vendors, or later on open source. You can create better methods within that box. You can create a better physical layer, but how it interacts with the next layer up is very well defined, and that's open, right? So the open part of the standards bodies are that. So, but in order to figure out what that standard interface needs to be. It's, it is, the standards process takes the approach that you want it to be somewhat future proof, right? So that you can capture the best available technology at that time. But at the same time, it's not so far ahead that only one or two people can build it at this time. Like, so how do you actually, so it is a very interesting process. So that's the intent. But then there is an anthropology to standards. You go attend these standards meetings. There are all people standing in these corners, and there's a lot of horse trading that's happening. It's like
Yep,
being in Congress.
that's my experience, my
Yeah,
my
yeah,
first job. But
yeah,
what's interesting is that standards unlock innovation.
they
Because
do.
if you don't have standards, you don't allow for innovators to come in and innovate
Yes.
within the interface. So
Yeah,
I also want to talk about another thing you mentioned before we move to your transition to NEA.
yeah,
You inherited portfolio companies
yeah,
during your time at Intel Capital. And there's this concept of uh, commitment escalation. You've invested in the company, you really like the entrepreneurs. So, of course, you want to do the follow investment.
yeah.
But that's not true when you inherit a portfolio company. You're looking at it with fresh eyes.
Fresh eyes, yeah.
Can you speak to what you've learned from this experience, which you are using today?
No, absolutely. That's a great question. And actually fast forward to NEA, I had a couple of those fresh looks as well. And um, yes, I think this was true of Intel Capital. Even at that time, it was an investment committee type of process. So there, Les was on the investment committee, and eventually, like, John Miner and Arvind Sudani. There were other people on the investment committee, and then was somebody from Treasury, and which was because we were investing off the balance sheet. And there was, somebody who looked at it from a legal perspective. But really, it kind of came down to the investment managers to think through, like, why are we making this investment? What is the case for investment? What is the investment thesis? What are the investment risks? So you had to kind of think through the why of this investment, and as well as the what and how, right? So, and you had to make this case. So at that time, this is now different, I think, at Intel Capital. But we had our investment committee meet with some of these companies, but many times it was us making the case for the company. It was not every company presented to the investment committee directly, right? So it was a different process than, for example, at NEA, where it really revolves around the company presentation, and the entrepreneur is making the case directly to the partnership. So, and this is the reason I'm alluding to your question. So when I inherited a number of these companies, I usually would see the reasoning behind the investment and what the reasoning was. And my thought process was to just figure out what things had changed and what things were still the same. Meaning, if you had invested in a faster telco chip in in um, in 2000, you had to sort of take a bet on whether the telco market was coming back, right? And so there were some things that kind of became obvious, like, and it was, it would be hard to wait for the telco market to come back if you had invested in a telco chip company, like an ASIC for telcos. Whereas, if you had invested in something that was a go forward model, like, and, we kind of found that with Netscaler, for example, we had invested in Netscaler before the bust. The idea there was actually, it was interesting. Netscaler was one of the first companies. We were just coming out of the ASIC period. Like, if you looked at a lot of in the 90s, in the enterprise space, a lot of companies created their own ASIC for a security product, for example, or a networking product. They all built their own ASICs for it, and people were funding that for that purpose. Netscaler was one of the first companies that I had seen where they still had sort of that ASIC type thinking, but instead of building their own ASIC, they just took an Intel processor and they ran a state machine on the processor. So rather than using all of the software stack and running a pure software approach, they had this hybrid idea where they used the Intel processor and built an embedded system. So it was not an ASIC and it was not a pure software appliance. It was something in the middle. And when I looked at that at one level, I said, well, the one thing that this company has going forward for it is that at least they don't have to make a huge amount of investment on the chips for the next generation, because they're relying on Intel to come out with better and better chips. And now you can just focus on, okay, what is the market they're going after? Like this load balancing market, is there a market for load balancing? And so then you kind of have this approach that says, yes, cost is important. That was around the time when Intel looked at VMware, and Intel eventually invested in VMware. But but the types of companies that came out in the 2000 to 2005 timeframe, a lot of them were focused on cost and efficiency, and trying to, because you had this period when it was highly capital constrained, but the internet build out, some parts of the internet had gotten a lot of overbuilding, but other parts had not gotten built out yet. And Netscaler had Google was a customer at that point, and Google was a small company, and
smaller.
yeah, and so we kind of looked at, one, high level, is the opportunity set still intact? Two, do they have customers, or do they have a plan where this is a viable offering that they're providing? And three, are the people still, what about the team? Like, because you had a lot of people churn as well, right? Where people who went through the 90s, and I think we're seeing the same thing now. There is going to be a churn, or there's a generational transition that happens whenever you have these things, as well as people on the cap table. There were a number of venture firms who no longer would want to invest, right? So even if I wanted to invest further in a company, if their entire cap table were not going to invest in a company, then it didn't matter. So you had to really kind of think through the product, the market, the people, and the cap table, and then understand, okay, whether this is and then the additional thing we had was, does this matter to Intel, right?
Yeah.
And I think, to be very honest, one of the powers of Intel Capital at that time and throughout was that there was a little bit of air gapping on that, to say, work and try to figure out whether this company will succeed or not, because let's not over rotate on what Intel needs. And certainly at that point there was, because it's hard enough trying to figure out what will work and how to engage with this market without having to put too much of a, what is the Intel product. But eventually you had to think about it, right? So we did have, like, that would be the next lens. So we would try to assess whether this was a good investment opportunity, whether this company could do well, right? That was sort of like, not because of financial, I mean, it was financial return, but you can't be successful with a strategic investing program if you don't build good companies. Like, you have to build companies, and they have to be strategically relevant. So at
That's
Intel,
a golden nugget.
exactly, right? So I do think that financial return is a good way to kind of think about what is the success of this investment program going to be, and then you put an additional strategic lens on it. And yeah, so that's sort of how we did the fresh look at Intel.
Which is very good, but it also means you're very thorough with this fresh look.
Yes.
Which potentially comes with a signal issue, which is, if you do decide not to invest, it's a very thoughtful decision. It's not just you decide not to follow. You've decided for very good reasons not to follow, which is a signal to the other investors. How do you handle that?
Yeah, I think at that point at Intel Capital, we were not lead investors at that point. For the most part, we were joining syndicates. There were a few where we were lead investors, and eventually Intel started leading a number of. So I think when you're a lead investor, that's a much stronger signal. but it's also good for the lead investor to be thorough like that, right? To actually say, this is, we are trying to create this. I would say that, if you decided not to follow, and you had good reasons for that, if you were not the lead investor and you communicated well with the company, yes, they're disappointed with it, but I think there are ways to sort of handle it. If you are the lead investor, and it seems erratic to the company and to your cap table, then it becomes very hard to continue to be the lead investor. Because there is this expectation that you have to, when in doubt, like, what do you do? Because there's a big gray area. There are some companies which are clearly like, this is not working, right? And you can say, okay, let's figure out an exit path, or clearly working and they have lots of options and there are other people.
But in between,
that is the hard part. And even when you're the sort of the large, you might be the largest investment fund, but resources are not infinite. You still have to go through that process of trying to figure out how do you make decisions when all the data is not there, right? And clearly, like, the way to sort of, one way to do it is to really quantify the risks that you've taken in the past, right? And so it's good to quantify the risks. And when you're making the decision, you write down what you think are the risks.
Yep.
And then you see whether those risks panned out or not, right? And the same thing is true for the fresh look, right? Where you say, there are some risks that have been taken off the table, they've been de-risked. Some new risks have come on board. So can we re-underwrite it in this way? And typically, you can have that same conversation with the entrepreneurs. And so sometimes it might be a valuation conversation, right? You just say, and when I was at NEA, I was the fresh look on Luxterra. So Forrest had invested in Luxterra, and actually the company, amazing company, was in the optical, at that point, active optical cables. Eventually, it became part of the optical backplane for server systems and so on. But the bet the company had taken was that there would be a transition from copper to optical. And that bet, people have been trying to take that over the last 20 years, because everybody knows that eventually a lot of interconnects will be optical, but when exactly that happens,
exactly, it's not the if, it's a when.
It's the when, like the market timing. So when in 2009, when I was the fresh look, when we re-underwrote Luxterra, we felt like the technology was fantastic, the team was still motivated, we had a great cap table, right? But we had missed the market didn't mean, like, there was another downturn. The copper to optical change was not happening at that point, and we thought it might be another 3 years out. It actually turned out to be another, several more years after that.
Yep.
But yeah, so when we did that, we said part of re-underwriting this has to be that the valuation has to be reset, right? So you do kind of, I think, but you have to bring everybody along through. If you are the lead investor, in the Luxterra case, we were, NEA was one of the lead investors, August Capital, Seven Rosen. They were also on the cap table. And when I was at Intel Capital, it was more about communicating internally and with the entrepreneur. Like, what is your thought process? Why is this not going to happen? In the case of when you're a lead investor at NEA, you have to now explain more thoroughly, like, what you're doing, and if it is going to be, yes, we're going to re-underwrite this, but at a different valuation, you also have to explain that. So I think the best you can do is explain it, and you won't win all of those popular. You may be unpopular at some point, but I think the best way to do it is to really think in terms of those bets and explain it and say, this is how we think about it.
So maybe my last question on fresh look, because it's such an important concept. Do you see value for this to be institutionalized in the VC firm, where it's always a new person looking into an existing investment, or do you think it doesn't have to be?
I don't think, I don't think it has to be, right? I would say that you can build an internal culture within a venture firm. So I would say for the most part, it can't be
Mm.
a fresh person. I think it is too disruptive to have this, because when you are in the middle, right, and you are like, there's so much emotion associated with that, right? Which is the entrepreneur. Obviously, if the entrepreneur wants to be right, is energized about going forward and keeping building,
Yep.
right? A, a lot of that is the entrepreneur needs a tribe around them, who does, if you continue to believe in that entrepreneur, it's better for you to be around them than somebody who's in their face saying you're not going to be, I think. So I don't think engineering an adversarial fresh look process is the best approach,
Mm.
because ultimately you're fighting with incomplete information,
Yep.
right? So, yes, if you believe you might be too Pollyannish, you might make a decision where there was not enough data to actually support it. But if you build a too adversarial a system, um, then you might essentially overlook opportunities that were there, because nobody can prove anything to anyone when it's so early, right? So I think the process has to be somewhere between, like, a rubber stamp, like it can't be that. And
Mm.
I don't think it should be adversarial. It has to be something in the middle, where it has to be thorough, like you said, right? And dispassionate, right? Somewhat dispassionate. um, and that you can get either through a consultative process, where like, it's my let's say it's a venture firm, you and I are partners, it's one of my companies, and they're clearly on the bubble, and we're looking at, hey, should we go back in and invest or not, right?
Yep.
I think you can instrument certain things on the fresh look, which is, let's call the customers and let's talk to the customers. So that should be part of the process. Do they really have customer traction or not? Let's call some of the employees and talk to the employees to see if the firm is energized. Like, do we have a company here, or do we just have an entrepreneur fighting a losing fight? So you could have some of those things, and it's certainly appropriate to have a partner who comes along with you for the ride, and then also counsels you, like, if you're too far gone on one side or the other. I think that is probably so adding a partner for a fresh look, and having that be a consultative process. And I think that is probably the best in the middle
Yep.
process.
No, I really like your granular view, because the first investment, there's so much you don't know, despite
Yeah,
all the due diligence you can do. The follow, you have so much more information, but then you
yeah,
start to have emotion and bias.
yeah,
And I think what you're proposing, which is a fresh look while complementing with the best information you have, is probably
yeah.
how you make the best decisions.
Yes, yeah. You have some new information, but it might still be very incomplete,
Yeah.
right? And yeah, so I think exactly. So I think something in the middle works. And you can instrument processes. You can say, when we are doing a fresh look, don't assume that it's always we're going to go back and say yes.
Mm.
um, and But these are the three things we should do. Like, we should call customers, like, we should have another partner do reference checks.
Yeah.
um, let's add to and so calling customers, talking to the employees or the management team, um, or even sort of a market view on, like, let's say this uh, optical versus copper, right?
Yep.
Let's go get a fresh market view. Like, let's go talk to some people on, hey, that was a bet we took, will it happen or not? I think those are all appropriate, right? So
Yep.
it is a version of the initial diligence. It's probably more robust than, if you had a company where things were going well, they have an up round, you're doing your pro rata, like, how much of a fresh look do you do, versus a company where you really have to now lead again. And so I think, definitely it is worthwhile to have a little bit more of a process for it.
Yeah.
But I think relationships are so important in this that I would not. I think it's hard to engineer something that's completely like adversarial.
No, I think your point about being more collaborative than adversarial is very important. And
Yeah,
to have the person bringing the fresh look, being the one interviewing the customers,
yeah,
reassessing the assumptions made, I think
yeah,
is really a golden nugget.
yeah.
Now, I want to move to your move. So you moved
Yes,
from one of the best CVCs with a
yes,
formidable mothership to
yes,
one of the very best tech VC in the world,
yes.
NEA.
Yeah,
So can you talk about what motivated the change, but more importantly, what it is that you were surprised
yeah,
once you joined NEA?
yeah. Yeah. Thank you. I mean, it was, and I was very fortunate. I was well. So what motivated the move? I think at some point during the Intel journey, I sort of did a little bit of my own self analysis, and said kind of which part of this do you like more. At that point it was still like pretty early. A corporate VC itself was not a career in itself yet, right? At least for somebody like me, where I had come in as an associate and I was really building a career in venture. um, the two paths that seemed obvious were either kind of growing within Intel, like you kind of keep growing within Intel and maybe go into the business units and take on more strategy roles or things like that, or be an investor, sort of be a professional investor over time. So I kind of decided that I was more in that second camp. I really enjoyed investing, and that's what I wanted to do for the rest of my career. And so that was the thought process. And it was not, and I kind of got to know Kittu Kaluri, who was just joining NEA. He had been an entrepreneur. He was at Neoterrace and the NetScreen, Juniper. And I actually met him at an alumni lunch. Like there was a professor, so we went to the same undergrad college in India, and I hadn't known him before then, But basically, we went to this alumni lunch, and we were just talking at the lunch, and he's like, "Where are you right now?" I said, "I've spent 6 or 7 years at Intel Capital. This is the type of thing I do." So he's like, "Hey, there," he called me a little bit later and said, "Well, I'm actually joining NEA. Would you like to come and join?" NEA. So that was how the process started. And I was leaning towards being an investor for a long time, and you could kind of continue to do that in other parts. Um, but that's how it started. There was a little bit more of a story to it, but I joined NEA as a principal in 2007. So and part of what it was clear was that they were, Intel also had this reputation of being fairly confrontational,
Mhm.
culture, like, so, with constructive confrontation, we like to call it. But it's a very good training ground. It does challenge you to make your case, really understand what you're trying to do, and also communicate that decision. But coming from a corporate, I think there was this question of like, would you be a good fit at an institutional venture firm? And I think that was that was the you know that was really the test for going from a principal to being a partner.
Yep.
And so I joined in 2007 as a principal, and I worked on several investments that year, because in terms of knowing how to make investments and actually helping the partners think through what investments to go in, how to structure these, all of those I was pretty good at. And I was promoted to partner the next year, so 2008, as we raised NEA 13. So I joined part of NEA 12. So I was part of NEA 12, 13, and 14 at NEA. I think, a lot of learnings, I guess surprises. Maybe, now I've been lived with it for a while. It's no longer a surprise. But I would say what I really felt, there was a difference, and I'll be very candid with you. There was a difference where um, investing is the main business of the place. Like, so at Intel Capital, even though we were very thorough, we were disciplined, we had other people doing this, there was still this element of um, this is not the main business of Intel, right? And so, like, periodically there's always a question of why are we giving millions of dollars to an outside company? I have all these other needs. I can spend more on R&D. I can spend more on
Yep.
marketing. So why are we taking like $150 million a year and giving it to like outside companies on risky bets?
Well, we're
So
not busy.
but like if you're not at Intel Capital, from the rest of Intel's perspective, there's
Yeah.
always a competition for resources, because this is one part of your operation, which is maybe not the main part of it's not your main business, right? Whereas at NEA, like, there's this sense that this is what we are here to do. Like, so all your discussions and the focus on company building, the focus on making good decisions, the focus on asset allocation, the focus on portfolio building, the focus on kind of really thinking through duration. So like, there's a duration match when you're in an institutional venture, which is very hard in corporate venture, right? Because like we were just saying, 95% of the company is working on things that matter this quarter, this year, maybe next year. But who's thinking? I mean, what part of the company is thinking about 5 years from now, 10 years from now? Very small part of the company, and usually for very small periods of time, usually during a planning cycle or like some budgeting cycle, people are starting to think about, okay, what else? But when you are at an NEA, you're very attuned to the venture timeline, right? So you kind of know why you're investing. You understand the risks and the milestone based de-risking. It's all kind of really well understood, and your partnership is like set up to work and make really good decisions. Um, it's possible to take that and replicate some of that in corporate venture, and I think that's what's been happening over the last 20 years. But I think that was big. Like, that was the big aha moment for me, saying, well, like, you come to a place like NEA, everything works towards making good decisions for investing, good investing decisions. And so some parts are very freeing, like, so you don't have to worry about some of those things. But I would say that there are many parts of corporate venture that are also very useful, like, because one of the things is, like, if you are in a venture firm, you could invest, especially a generalist venture firm, you could invest in anything, right? So clearly, like, you look at some of the best investors, they've invested in consumer as well as enterprise. And the old times, they would do healthcare and tech. Like, so the investment was its own skill set, and they could do that. But I think over time, it's also been deepening and sort of becoming more thematic, right? So one of the things that I do appreciate is that when you are at a corporate and you're looking at the landscape around you, you have sort of a frame of reference to. So you're not like wildly going off on things that you don't know. You're actually working from a base of knowledge, and you're saying, okay, step 1, step 2, step 3, this is where things could get, and you have a frame of reference on it. And I think the other thing that was also, I feel very helpful, is having been an engineer and having been at a product company, you have you have a knowledge of how things are built, that are also very, very helpful. Which, I mean, obviously at NEA, a lot of people had that as well, but I think it is very important, because there are investors who don't have that skill set at all, right? So you kind of bring a very slightly different perspective to it. Ultimately, you're making an investing decision, and if you want to make the best investing decision possible, you need to have all of those skill sets around it.
So let me have a question about boards, because you mentioned K2, and we co-invested in the same company in Boston, Metalens.
Yes.
Last week we had a board meeting, and Kitu is exceptional in asking very few questions, but really the question that matters.
Yes.
So do you have any golden nuggets about how you contribute to a board for better decision making? What's your superpower in a board?
Yeah, I think, I agree with you. I really enjoyed working with Kitu, and we were on many boards together. And in fact, like the first investment I made, it was a company called Plusmo, and both Kitu and I went on the board in the mobile space and so on. So I would say that what I have figured out about my own board presence and so on. I really enjoy this product market fit stage, right? And but there are like these phases to a company. So the best thing to know is sort of where is this company in its own development cycle. And some of it is linear, and some of it is like iterative. So you need to kind of figure out where that is. So at the start of a company, like we invested very early when I was at NEA. These were all very early investments, like Aerospike, for example. The first check I think they had raised a small $2 million round, but it was Series A that we led in 2012, right? Very early stage, and joined the board there. So at that stage of the initial stages of the company, often the board member is an extension of the team, right? So you're effectively, if you had this, again, the spectrum of governance versus part of the team, like you're very much towards part of the team, like and I think most helpful is like when you can use the board meeting as sort of a strategy session, right? So I think the value with a lot of these early stage companies, this was true of ViewClip, for example, where actually Kitu and I were both again on the boards. It eventually became an OTT company that was acquired by PCCW. But when we first started, they had a technology for mobile transcoding that sped up delivery of content and so on. A lot of that was about product market fit, right? What is the business model? Who are the potential customers? And you're trying to iterate with what the company is seeing on a month-to-month basis. So we actually in the early stages, I very much take the attack of like, okay, if I'm an extension of your strategy team, like how would you think about it? And let's have a conversation about it. So in the early days, most of these board meetings are maybe like half an hour of report outs, and like do the standard report outs and where things are, or even send the deck beforehand. And then but spend an hour or hour and a half on like 2 or 3 questions, right? What is the most important thing you need to figure out, right? And it could be product, it could be hiring, like it could be competition, it could be fundraising, like whatever the deep dive needs to be, like, so you have that. As the company grows, then you sort of have to morph your own role as well. There are usually more people around the table, right? And also more people on the company side, and you don't want the board member to be like viewed as an operating like don't tell me what to do type of thing. So you kind of morph more towards being in council. And I think you also start asking more governance type questions, because there you're starting to work off of data more than sort of signals. Let's like a smaller signals. So you're starting to think about, do we have a CFO, do we what are the systems you're putting in place, and so on. So I think the board role has to change. Like first of all, you have to have the flexibility to change that. And then I would say that it also depends a little bit on who else is in the mix. But it is really important that in a big board, let's say you have 4 or 5 people, like you're saying, that's the right thing. Kitu shouldn't, it's not his board meeting to run, right? Somebody's running the board meeting, but you need to guide the conversation and make sure that those deep dives are getting, that the company is getting the right inputs along the way.
And sometimes the question is a very strong input. So
Yes.
I agree with that.
Yeah.
So I want to talk about, you were in NEA and then you decide to move back to a corporate VC, although
Yeah.
arguably more of a financial VC than a corporate VC,
Yeah.
NGP.
Yeah.
And I would like you to frame it as why the change, and also within your framework of innovation rail, because I
Yeah.
think that was really critical element here.
Yeah, absolutely. So, I was fortunate enough to be recruited by NGP Capital, and they were looking. This was Nokia's venture arm. At that point, it was, as you mentioned, it was an LP-GP structure. So it was Nokia was the single LP, but these were managed as funds, separate funds, and there was $1.5 billion of assets under management. So I joined NGP just at the start of NGP4, which was a $350 million fund focused around the 5G transition, right? So the reason it was, so there were a few reasons why it was interesting, but one of the reasons they called me was they were looking for an enterprise, especially enterprise infrastructure leader. And if you kind of think about from NGP's perspective, um, you know, just think of the funds as roughly around 2G, the 2G transition, 3G transition, 4G transition, 5G transition. That those were sort of the funds that existed, and 2G and 3G were more about mobile penetration, about international markets. So NGP did have significant investing in China and India, in the previous funds. 4G was mostly around the app economy, right? So, how it enabled the app economy, and you participated in the boom that followed. So even more than the connectivity layer, like we were talking about value creation versus value capture.
Yep.
The value capture happened at the software layer, at the app economy layer. And if you could figure out the business model that motivates this classic shift, you would make a lot of money. And around the 5G transition, there was this realization that this is going to be more of an enterprise network than previous networks. So, for example, in the 5G world, there is no assumption that a device that joins a network is a mobile phone, right? It could be a car, it could be a smart meter, it could be a robot. These are all devices that are capable of joining a 5G network for the first time, like everything. So whether it is identity, whether it is a number of the software layers, there is no assumption that this is going to be all about phones. It's going to be about all of these disparate devices.
Internet
So
of
for us, we felt that the Internet of Things, yeah, exactly. It is more of an IoT network, or it's capable of being well beyond it. Of course, you get capacity, for mobile telephony. You enable a lot of the additional capacity, additional data, and so on. But it also enables this enterprise, these enterprise use cases, and private wireless, for example, which is outside of the classic telco wireless. Private wireless is an enterprise sale, and a lot of the initial 5G installations were in private wireless for ports and manufacturing and warehouses and so on. So these industrial use cases were a very important part of it. So I was, when I joined NGP, I was certainly interested in those use cases, like figuring out what is the application layer and what is the potential business model. What's the equivalent of the app ecosystem, the app store? That is one area, and we have some clues on what that is. But then there is also a very interesting intersection. 5G is the network where it also interacts very interestingly with the cloud. Um, Already with 4G, like mobile and cloud created a new, like the enterprise perimeter went away because everybody uses mobile devices. So it changed security, like mobile 4G changed security, right? And because it interacted with the cloud, and with that, you had a completely new type of usage for enterprise workloads. With 5G, I think that's true, where now you have bolstered edge. The edge cloud is a big component, and you already have something like 30 billion, they say 30 billion connected devices. It's actually 30 billion connectable devices, because the network really hasn't existed for many of these industrial connectable devices to actually, like, they're not fully built out. And for them to be fully built out, you have to have a robust cloud ecosystem, a robust data model, a way for developers to actually access it. And now more increasingly AI, because these are machine workloads. You need AI for you to actually make sense and activate some of these use cases. So I could very clearly see this. So at the 5G bubble, that the network more than ever related back to compute and storage and data and so on. So I started investing in some of those. So I invested in a company called Immuta, which is in the data engineering space. Invested in Platform 9, which is in these Kubernetes management area there. For telcos, it's an important Kubernetes. This is again going back to our open source comment, right? Which is, at these transitions, open source becomes relevant. And so we've invested in some very interesting companies in and around that. So that's what drew me there, which is I did have kind of the wireless skill set from Intel Capital. I'd invested in a number of interesting enterprise and cloud and storage types of companies at NEA, and I had this opportunity to actually kind of do the strategy for how does the network, at the 5G transition, how does the network relate back to everything else that's happening in Silicon Valley, right?
And I think it's a perfect transition for my final question, which is, what about new build?
Yeah.
And for the entrepreneurs who are listening in, what are you most excited to invest in the next year or so?
Absolutely. Thank you. No, and it directly relates to it. It's been a wonderful conversation, by the way. Thank you for these great questions. So new build is really a continuation from what we were working on at NGP. So maybe a generalization of that, right? And so my partner Chad Bailey and I were both at NGP. He worked more on the supply chain. As I was mentioning, private wireless went into these supply chain type use cases, and he was investing in that application layer. And I was looking much more at this infrastructure connection, relating back to cloud and AI and data and so on. We were doing this in the context of 5G. So through this 5G keyhole, we saw that supply chain was very, very important. As the pandemic rolled through, we had this realization that this is a gigantic market, right? So if you look at the front half of enterprise, like you look at marketing, sales, customer service, and all of those things, as they have gone to cloud, as they've gone to AI, it's created over $1 trillion of software value. Everything from a Salesforce to ServiceNow, plus all the new infrastructure software companies that you see. We think that, but you look at the back half of enterprise, in what we think of broadly as a supply chain, it runs a lot of old software. They're on a lot of old systems that were written 20, 30 years ago, right? Many of them on-prem systems. They're still only partway through the cloud transition. A lot of these systems were written before there was cloud, before there was AI, before there was even GPS, right? So our belief is that over the next 10 years or next 20 years, the back half of the enterprise is going to grow much faster, right? And there is going to be this architectural transition to the cloud, to AI, and so on. So anything from procurement to manufacturing software to distribution, warehouses, logistics, payments, supplier intelligence, they're all there is an architectural shift happening which will unlock $1 trillion of value. And so that's we're very much focused on that. And we think there are a number of market drivers for why that transition is going to happen, or why there is a buying cycle, which is, one is there is a focus on resilience in the supply chain. Yep. Post-pandemic, every enterprise board has been focused on creating more resilience. every chief supply chain officer wants to stop being in the spotlight at
Yep,
every board
yep.
meeting, right? So resilience, and I think we are already building resilience with the new data architecture, and increasingly, like the new data lets you, real-time data lets you build resilience, and we are starting to see some of that already. The second big driver is all the geopolitics. So supply chains are getting scrambled and rearranged, and as you see that scramble, we think it pulls in a lot of new software. Similarly, there's a focus on sustainability. There's a lot of technology available right now that actually solves the problems around sustainability and supplier tracking and supplier intelligence that people have been wanting to do for a long time, but I think now it's possible to do. That's drawing a lot of new software. And then this architectural shift and the readiness. So we kind of put all that together to say we want to build a portfolio of companies that are squarely in that back half of enterprise, focused on supply chain, all software. And we explore that space, everything from the first mile, which is sourcing raw commodities, procurement, all the way to the delivery of the final goods, enterprise oriented,
End to
and as
end.
well as these new layers. Like, so we want to see the new plaids of the world, new data robots of the world, and so those are all the things we invest in.
Well, Rohini, it was wonderful to have you, and you shared so many golden nuggets from your journey, from investing, from being on the board, from innovation rails. Thank you so much.
Thank you so much. Thanks for having me. Look forward to listening to this podcast.